Right now, the financial world is quiet. The screens are dark. The tickers are frozen. But behind the silence, a storm is gathering. For months, trillions of dollars have been waiting on the sidelines, poised to move, and the target is clear: silver. Pension funds, institutional giants, and hedge funds are about to unleash a wave of capital unlike anything this market has ever seen. The question is not if the price will move. The question is how violently it will surge, and who will be left holding the empty vaults when the chaos hits. The countdown has begun. The answers lie in the mechanics of money, the limits of supply, and the unseen hands controlling the flow. And tonight, everything could change, but only for those watching closely. Welcome to Hidden Currency, the channel where we uncover the real forces shaping global markets. Before we begin, I have a small request. If you're watching this wherever you are, in New York, London, Shanghai, or Mumbai, take a moment and hit that subscribe button. Think of it as keeping an old friend informed, someone who has seen the markets rise and fall and knows that knowledge is power. Now, let us break down exactly what is happening and why this 50 billion wave of buying could reshape the silver market forever. In the world of institutional finance, timing is everything. The end of one year marks the close of fiscal reports, the tallying of gains and losses, and the rebalancing of portfolios. By December 31st, managers have completed defensive maneuvers. Winners are sold to secure bonuses. Assets are shifted to reduce risk exposure. Losses are harvested for tax advantages. But as the calendar turns to January the 1st, a transformation occurs. The fiscal year resets. Targets for the new year activate. Institutional models, computerized and precise, demand execution. Every major pension fund has a mandate: maintain specific allocations across asset classes, commodities, gold, and now increasingly silver. This is not speculation. This is obligation. These institutions are not trading for sentiment. They are trading for compliance. And in 2026, the signals are clear. Silver was the best performing asset of 2025, outperforming expectations and defying volatility. As a result, algorithms within these funds are signaling unequivocally buy. Yet, the market is unprepared. Unlike paper derivatives, which can be created in vast quantities, physical silver is finite. The annual global mine production is roughly 800 million ounces. At $71 per ounce, that is just over $56 billion in total market value. Now imagine that only 0.1% of the total global pension and endowment assets, about $50 trillion, flows into silver. That is $50 billion chasing a market worth just $56 billion. Nearly the entire yearly supply would be demanded in a single week. The math is simple, and it leaves no room for error. The market simply cannot absorb this much buying without the price rising dramatically. They understand scarcity. They know the vaults are empty. Dealers are reporting sold-out inventories. Mines are hoarding. The first wave of capital will hit a wall of physical shortage. Price is the only rationing mechanism available. It must rise until the $50 billion buys less and less silver. If the price doubles, half the annual supply is purchased. If it quadruples, only a quarter is available. The market will force a revaluation simply because there is not enough metal to meet demand. Algorithms will play a critical role. While the Western markets were closed over the new year, Asian exchanges were still active. Arbitrage opportunities have grown. The gap between prices in New York, London, and Shanghai is significant. Automated trading systems are programmed to exploit these differences. As the electronic exchanges reopen, they will act instantly, snapping up the cheapest available silver. This early move will signal human traders that the bottom has passed, creating a surge of buying from those who fear missing the move. Retail investors are watching too. They notice rising premiums on coins and bars. They notice dealers reporting empty shelves. Every ounce purchased removes supply from circulation, tightening the market further. The public senses urgency and begins buying, not because of algorithms, but because they see scarcity and fear losing out. The combination of institutional mandates and retail panic will create a self-reinforcing cycle. Banks, who played a suppressive role in 2025, are observing the scene closely. Last year, they sold aggressively to manage risk and preserve bonuses. The year-end snapshots are complete, and regulators are temporarily absent. The banks are free to trade again. They understand the flow. Pension funds and industrial buyers will create a buying wave in the first week of January. They are preparing to front-run orders, buying ahead of pension funds and selling into the initial surge. The suppressors of 2025 will become the squeezers of 2026. Part one of this story is about preparation. The stage is set, the capital is ready, the metal is scarce, the algorithms are awake, the retail market is alert, banks are poised. As the first electronic bell of 2026 approaches, the market is calm only on the surface. Beneath that calm lies a wave of buying so large that it cannot be absorbed without massive price movement. And the question remains, who will secure the metal and who will be left chasing empty vaults? This is the opening act of the $50 billion silver wave. The first week of January will determine the course of the market for the months ahead. What follows is not speculation. It is mechanical, predictable, and unstoppable. The countdown has begun. As the electronic markets prepare to reopen, another layer of the silver story emerges: the physical market. While algorithms and pension fund mandates dominate headlines, the reality on the ground tells a different story. Vaults are empty. Dealers are exhausted. Factories in China, Mexico, and Peru continue to produce silver, but supply cannot keep pace with the sudden surge in demand. He watches the reports coming in from major bullion dealers across the United States and Europe. They are clear. Shelves are bare. Silver Eagles, Maple Leafs, and industrial bars are disappearing faster than they can be restocked. For ordinary investors, this appears as a normal price movement. For those who understand institutional dynamics, it is a warning sign. Every ounce sold today represents a permanent reduction in available inventory for the critical opening week. The industrial market is feeling the strain first. Companies that rely on silver for production, solar panels, electronics, medical devices, are already negotiating contracts for 2026. Suppliers report shortages and warn that allocations will be reduced. A solar company in Arizona, for example, may need 100 tons for the year. Suppliers inform them that only 70% will be delivered. Industrial buyers are forced to compete directly in the spot market, bidding higher than ever to secure supply. Meanwhile, retail investors notice the disconnect between spot prices and premiums. While the paper market might suggest silver is stable, coins and bars are selling at record premiums. A Silver Eagle that traded at $5 over spot just last month now carries a $20 premium. Dealers cannot replenish stock because mints and refineries are closed for the holiday. Every purchase removes an ounce from circulation, amplifying scarcity. Banks watch this chaos unfold. Last year, they were suppressors of the silver price, selling aggressively to reduce risk. Now, they are repositioning. The year-end snapshots are complete and regulators are temporarily absent. Banks understand the flow. Pension funds and industrial buyers will create a buying wave in the first week of January. They are preparing to front-run orders, buying ahead of pension funds and selling into the initial surge. In doing so, they flip from suppressors to squeezers, leveraging the scarcity to their advantage. Algorithms act as a force multiplier. During the New Year holiday, the gap between US and Asian markets grew. Shanghai and Hong Kong remained active while New York slept. Arbitrage bots now scan for opportunities, ready to exploit price discrepancies instantly. The first wave of buying from Asia will push New York prices higher at the opening bell, signaling to human traders that the bottom has passed. This triggers an immediate reaction: fear of missing out spreads like wildfire. They understand that the human element intensifies scarcity. Retail investors see rising premiums, sold-out signs, and headlines about institutional buying. Even small purchases remove silver from circulation. Each ounce removed tightens the supply chain further, increasing pressure on the next wave of buyers. The market is not responding to sentiment. It is responding to reality. Physical silver simply cannot be created on demand. The pressure on miners is visible as well. Mining operations cannot instantly increase production. Even if prices spike, new mines take years to develop. Permitting is slow, and political risk in key countries limits growth. Governments in Mexico, Peru, and China are watching the rising price and adjusting export policies, adding uncertainty and constraining supply further. What begins to emerge is a clear pattern. The paper market may appear liquid, but the physical market is tightening rapidly. The disconnect between what is traded digitally and what exists physically is widening. This divergence is a signal to the informed investor. When the paper market eventually aligns with reality, the adjustment will be violent. The first signs are already visible in dealer networks. Online bullion stores report inventory blowouts, orders are canceled, delayed, or backlogged for weeks. Premiums climb daily. Industrial buyers pay over $80 per ounce to secure delivery in January. Banks, pension funds, and hedge funds observe this data carefully, preparing to act as the initial wave of capital flows hits. This stage of the story is critical. Part 2 is not about speculation or hype. It is about mechanics, limited supply, institutional pressure, and industrial panic intersecting at the same time. Each actor, retail, industrial, and institutional, feeds into the other. The scarcity is no longer abstract. It is visible, measurable, and unavoidable. As they watch the opening bell approach, the key question becomes, who will access the physical silver first, and at what price? The market is no longer about who wants to buy, it is about who can, and the answer will shape the trajectory of silver for the entire year. The $50 billion institutional wave is not coming. It has already begun, and the consequences of its collision with a limited physical supply are unavoidable. The stage is set for a vertical move, where every ounce counts, every order matters, and every delay in supply becomes amplified in the pricing mechanism. When the algorithms, banks, and industrial buyers converge, the first week of January will not just be a trading week, it will be the opening act of a structural shift in the silver market. As the calendar turns to January, the market is poised on the edge of a transformation. While Part 1 exposed the $50 billion institutional wave, and Part 2 revealed the physical scarcity gripping dealers and industrial buyers, Part 3 examines the hidden actors who will accelerate the shift, the banks and algorithmic systems that orchestrate the institutional squeeze. For months, certain banks acted as suppressors of the silver price. They held large short positions, manipulating paper contracts to maintain stability or to protect their own balance sheets. December 31st was the peak of their defensive operations, selling aggressively to manage risk scores, lock in bonuses, and reduce exposure. The world watched the paper market and assumed silver was weak, but the truth was concealed beneath layers of derivatives. Now, the defensive phase is over. The year-end snapshots have been submitted. Regulators, temporarily absent, leave banks free to execute their next strategy. They do not buy for hobby or sentiment. They buy for profit. They understand the flow of capital that is about to hit the market. Pension funds and institutional portfolios are mandated to enter aggressively in the first days of January. Banks position themselves to ride this wave. This strategy is simple but powerful. Banks will front-run orders, purchasing silver ahead of institutional clients. They will buy at prices below the inevitable surge and sell into the first spikes. This front-running transforms them from suppressors into squeezers. What was once a defensive mechanism becomes a proactive driver of price acceleration. Every bank that executed heavy shorting last year now has the opportunity to capitalize on the scarcity they helped engineer. Algorithms amplify this effect. Over the new year, Asian markets remained open while Western exchanges were dormant. Price gaps emerged between Shanghai, Hong Kong, London, and New York. Arbitrage bots, programmed to exploit these differentials, are poised to act instantly at market open. When they detect cheaper silver in New York, automated systems will buy immediately, transporting value to Eastern markets where premiums are higher. This rapid movement creates a mechanical shock. The first wave of purchases triggers human traders, igniting fear of missing out behavior. They understand human psychology. Retail traders, influenced by social media market reports and rising premiums, will respond quickly to these early moves. Sold-out signs, historic dealer premiums, and headlines about institutional activity all reinforce urgency. Each human purchase removes physical silver from circulation, further limiting supply and intensifying the squeeze. The convergence of algorithmic speed and human behavior creates a feedback loop, a cycle that drives prices higher while supply remains fixed. Industrial actors cannot escape this pressure. Solar manufacturers, electronics companies, and medical device producers all compete for the same finite supply. Even with large contracts in place, suppliers cannot meet full demand. These buyers are forced to engage directly in the spot market, paying premiums well above the current paper price. The institutional wave, combined with industrial panic, establishes a hierarchy. Banks and algorithms secure the most efficient allocations, followed by pension funds, then industrial buyers, and finally retail. This stage reveals the structural mechanics of the squeeze. The price of silver is no longer a reflection of sentiment or conventional supply and demand. It is the rationing mechanism of last resort. Every $1 increase reduces the amount of silver any given buyer can secure. Capital meets scarcity, and the market is forced to adjust. The velocity of these adjustments is staggering. A few $1 billion flowing into a limited market can push the price far beyond any technical resistance levels established in 2025. What makes this situation unique is alignment. Previously, banks, pension funds, retail investors, and industrial buyers operated in semi-independent spheres. Now, they are all converging toward the same metal at the same time. The East is buying. Pension funds are buying. Banks are front-running. Retail investors follow in response. Industrial buyers chase allocations. There is no counterbalance. Every ounce of silver becomes contested, and every delay in supply magnifies the next wave of buying. Part 3 is critical because it shows that the market's next movement is not random. It is highly structured, predictable, and enforceable by sheer mechanics. Banks, armed with foresight, algorithms, and strategic positioning, act as both catalysts and regulators of the initial surge. Their decisions transform scarcity into vertical price movement. What emerges is a perfect storm, a collision of institutional mandates, physical shortage, algorithmic arbitrage, and industrial urgency. The stage is set for January's opening week. The question is no longer if silver will move. The question is how far, how fast, and who will secure their position before the metal vanishes from circulation. Part 3 ends with anticipation. Banks are ready, algorithms are primed, and pension funds are queued. The wave is imminent. The only uncertainty is timing. And as the first trades of 2026 are about to hit the screens, every market participant, retail, industrial, or institutional, must understand one truth. In this environment, hesitation means missed opportunity, and even small delays can be costly. The institutional squeeze is about to begin, and it will redefine the dynamics of the silver market for months to come. By the time the first week of January unfolds, silver will no longer be a mere industrial metal. It will have become a focal point in a global financial narrative shaped by scarcity, institutional flows, and rising geopolitical tension. While parts 1 through 3 laid the groundwork, the $50 billion wave, the physical shortage, and the institutional squeeze, part 4 reveals the macro forces that could transform this technical market event into a historic monetary phenomenon. The financial system operates as a network of interlocking pressures. Debt, deficits, and liquidity interact in ways that often remain invisible until a trigger arrives. In early 2026, several triggers are converging. First, the United States is approaching another debt ceiling confrontation. Interest on outstanding debt has escalated, with the government now paying over $1 trillion annually in interest alone. This alone is larger than the defense or Medicare budgets. The math is clear. The system cannot sustain itself without intervention. Pension funds and banks are aware of the macro context. They understand that the debt ceiling will create panic in bond markets, that yields may spike, and that even the Federal Reserve will be forced to act in extraordinary ways. When yields rise too high, banks holding bonds as collateral face solvency risks. To stabilize the system, the Fed may be compelled to flood markets with liquidity, triggering another round of monetary expansion. In other words, the physical squeeze in silver is colliding with a looming fiat expansion, a perfect storm for price acceleration. Meanwhile, the BRICS nations are actively positioning to reduce dependency on the US dollar. China, India, Russia, Brazil, and South Africa are exploring alternatives for global trade settlements, including the potential for a commodity-backed currency. Silver, traditionally a monetary metal, could become a component of this emerging framework. In this scenario, the East effectively establishes a floor under silver's price. Demand is guaranteed, and supply is finite. This macro perspective also highlights another crucial element: inflation. Despite claims from central banks, true inflation is rising globally. Oil, shipping, labor, and insurance costs are all increasing. Pension fund algorithms account for this, prompting a shift away from bonds and into tangible assets. Silver, being both industrial and monetary, becomes a dual-purpose hedge, protecting against currency debasement while maintaining utility and production. He observes the interactions carefully. Banks, once shorting silver to reduce risk, are now aligned with the institutional wave. Arbitrage between Eastern and Western markets amplifies volatility. Retail and industrial participants add pressure. At the same time, macroeconomic conditions, rising yields, political risk, and the potential collapse of fiat trust combine with supply scarcity to create exponential price pressure. Every factor compounds the others. This is no ordinary trading event. It is a coordinated alignment of economic forces, both visible and hidden. The timing is critical. The opening bell of 2026 marks more than a trading day. It signals the start of a structural market shift. Pension funds, forced to execute large allocations, meet limited supply. Banks front-run and arbitrage bots exploit every inefficiency. Industrial buyers compete for essential material. Retail investors, sensing both scarcity and momentum, follow in droves. Every ounce of silver is contested, and every moment of hesitation has a cost. Now, consider the implications for price discovery. In the paper market, silver may appear stable. Futures contracts, thinly traded over the holiday week, obscure the real pressure. But in the physical market, scarcity is absolute. Dealer premiums have soared. Industrial contracts are partially fulfilled at extreme cost. When institutional orders collide with these constraints, price rises must be rapid and nonlinear. A $50 billion inflow does not gently nudge prices. It forces them upward until equilibrium, however temporary, is restored. The final layer is psychological. Markets respond not only to mechanics, but to perception. As premiums rise, algorithms signal upward momentum, and the media reports scarcity, a feedback loop forms. Panic buying and fear of missing out accelerate demand even further. Even conservative investors, who would normally avoid silver, now face a simple choice: acquire the metal or risk being excluded from the first wave.